Have you been looking at the headlines recently? The Sensex has soared past 86,000, and the Nifty is touching new all-time highs above 26,200. On the surface, everything looks brilliant. The news channels are buzzing with excitement, celebrating a bull market in full swing. But when you open your own investment portfolio, the story feels completely different, doesn't it? Instead of seeing those celebratory green numbers, you are probably seeing a lot of red. If you are feeling confused and asking yourself, if the market is doing so well, why am I losing money? Please know that you are not alone in this feeling. This strange situation is something we can call the index illusion. Think of the Nifty 50 or the Sensex 30 as an average score for a class of students. If just 2 or 3 top students score exceptionally high marks, they can pull the entire class average up, even if most of the other students have performed poorly. This is exactly what is happening in the stock market today. A handful of heavyweight, large-cap companies like Reliance and HDFC Bank are performing so well that they are single-handedly dragging the entire index upwards. Their sheer size gives them a massive influence on the index's final number. This creates a dangerous illusion of a healthy, booming market for everyone. In reality, what we are witnessing is a K-shaped recovery. The big stocks are on an upward trajectory, forming the upper arm of the letter K. Meanwhile, the majority of stocks, especially in the mid-cap and small-cap segments where many retail investors like us have put our money, are either stagnating or heading downwards. They form the lower arm of the K. So, while the index paints a rosy picture, the health of the broader market is actually quite weak, and your portfolio is likely reflecting this unfortunate reality. The problem is that this disconnect can be incredibly misleading. New investors, drawn in by the exciting headlines of a record-breaking market, might jump in without realizing that the tide is not lifting all boats. They might invest in the wrong places, expecting everything to be going up, only to find their capital eroding. It is a classic trap where the market's overall performance is not representative of the average stock's journey. Understanding this illusion is the first crucial step to protecting your investments and making smarter decisions in a very tricky market environment. Now that we understand the index illusion, let's talk about another major reason your portfolio might be under pressure. This December, the Indian stock market is bracing for a massive event, a tsunami of initial public offerings, or IPOs. A huge pipeline of companies is set to go public, aiming to raise an astonishing 30,000 to 40,000 crore from the market in just 1 month. This isn't just a small wave. It is a significant financial event that will suck a massive amount of money, or liquidity, out of the existing market, creating what we can call a liquidity vacuum. So, how does this affect your existing shares? It's a simple case of supply and demand for money. When these big, exciting IPOs open for subscription, many investors get caught up in the hype. To apply for these new shares, they need cash. Where do they get this cash from? Very often, they sell the stocks they already own in their portfolios. This creates widespread selling pressure across the board, especially in the mid-cap and small-cap segments. As thousands of investors sell their holdings to free up funds, the prices of those stocks naturally begin to fall. This phenomenon is not just a theory. It is a predictable pattern. With so many tempting IPOs hitting the market at once, the demand for funds skyrockets. This year, 2025, is already on track to be a record-breaking year for IPO fundraising, and this final push in December is the grand finale. This coordinated rush for cash puts a strain on the entire secondary market. Even fundamentally strong companies can see their share prices dip, not because of any bad news about the company itself, but simply because the market is being drained of available money to invest. Therefore, the dazzling allure of new IPOs can have a dark side for your current investments. The very act of chasing potential listing gains in new companies can cause real, tangible losses in your long-term portfolio. It is a classic December trap. The market indices might still look strong because of the big players, but beneath the surface, your stocks are facing a double whammy: the index illusion, and now, this massive IPO-driven liquidity drain. It's a perfect storm that can leave many retail investors feeling frustrated and poorer. Let's zoom in on two of the biggest names in this upcoming IPO frenzy, Meesho and ICC Prudential AMC. These two companies alone are expected to raise over 16,000 crore, making them the headline acts of the December IPO season. While the hype surrounding them is immense, a closer look reveals some potential red flags that every investor must consider before putting their hard-earned money on the line. These are not guaranteed lottery tickets. They are businesses with their own unique risks that you need to understand thoroughly. First, let's talk about Meesho. It is a massive social commerce platform with a huge user base, and its IPO is expected to be around 6,000 crore. On the surface, this sounds exciting. However, when you dig into its financials, you find a worrying picture. For the financial year 2025, the company reported a staggering loss of nearly 3,900 crore. A company that is losing such a significant amount of money is asking for a very high valuation from the public. This raises a critical question. Is the valuation justified, or is it purely based on hype and the size of its user base, rather than on a sustainable, profitable business model? Next up is ICC Prudential AMC, a well-established and respected name in the financial services industry. Their IPO is even bigger, aiming to raise around 10,000 crore. The company is profitable and manages a vast amount of assets. So, what could be the problem here? The issue lies in the structure of the IPO itself. The ICICI Prudential AMC IPO is a 100% offer for sale, or OFS. We will discuss this in more detail in the next section, but in simple terms, this means the company itself will not receive a single rupee from this 10,000 crore fundraising. The risk with Meesho is its questionable profitability and high valuation, while the risk with ICICI Prudential AMC is the motive behind the IPO. In one case, you are betting on a loss-making company to magically turn profitable. In the other, you are buying shares from existing owners who have decided that now is the perfect time to cash out. Neither scenario is without its significant dangers. It is absolutely essential to look past the brand names and the media excitement and analyze the cold, hard facts before you decide to invest. We have mentioned the term offer for sale, or OFS, and it is a concept that every retail investor needs to understand, especially when it comes to the ICICI Prudential AMC IPO. When a company raises money through an IPO, the money can be raised in two ways: a fresh issue of shares or an offer for sale. In a fresh issue, the company creates new shares and sells them to the public. The money raised from this goes directly to the company, which it can then use for expansion, paying off debt, or funding new projects. This is generally a good sign, as it shows the company is raising capital to grow. However, an offer for sale is completely different. In an OFS, no new shares are created. Instead, the existing shareholders of the company, such as the founders, promoters, or early investors, sell their personal shares to the public. This means that the money you pay for the shares does not go to the company at all. It goes directly into the pockets of the selling shareholders. A 100% OFS, like the one for ICICI Prudential AMC, means the entire IPO is just an exit opportunity for the current owners. The company itself gets nothing. Why should this be considered a red flag? Think about it logically. The people who know the company best, its owners and promoters, have decided that this is the best possible time to sell their stake and take their money off the table. This should make you ask, why now? If they believe the company has a fantastic future with lots of growth ahead, why would they be selling? A large OFS can often signal that the promoters feel the company's stock is at its peak valuation, and it might be all downhill from here. They are cashing out at the top, leaving retail investors to hold the shares. This is not to say that every OFS is bad, but a 100% OFS from a promoter is a very strong signal that requires deep investigation. You are not funding the company's future. You are simply buying out an old investor. Before you invest in any IPO, especially one with a heavy OFS component, you must do your own research. Do not get carried away by the market hype or the big brand names. Read the IPO document, understand the business, check the financials, and most importantly, Ask yourself why the existing owners are so eager to sell. Your financial well-being depends on your own diligence, not on market noise.